Good morning, everybody. My name is Erin Holderson. I'm the Director of Undergraduate Class Giving here at Stanford, and I have had the pleasure and privilege of working with many alumni classes during the reunion years over my last 9 years here at Stanford. Before we begin, I wanted to tell you a few housekeeping items. We are muting all of the lines so we can control the background noise and allow for a good listening experience for everyone on the call. Thank you for the questions you've submitted in advance. We've worked those into the content of the call and are happy to answer those. If you do have questions during the call and are using the Zoom platform on your computer, you should see a chat box there at the bottom of your screen. And if you're dialing in from your phone, we welcome follow-up questions, or you can email those in and we'll get back in touch with you, or have one of our plan giving experts here get back in touch with you to make sure we answer any follow-up questions there, but we're happy to answer those chat box questions live. First and foremost, again, let me say thank you so much for your time, support, and effort on behalf of your alma mater. Reunion campaigns are so critical to Stanford's continued excellence and ability to invest our necessary resources and solve some of the world's most pressing problems. So we're just so grateful to have all of you here. Thank you so much. I know this is a lot of time out of your year, and the amount of support it provides for us is incredible. So thank you. I'm here today with 3 of my colleagues from our Plan Giving office, and I'll introduce them in just a minute. But first, I wanted to introduce Norm Boone, class of '69, who is celebrating his milestone 50th reunion this year. Hi, Norm.
Good morning.
Norm is one of our dedicated campaign volunteers who signed on this year as a planned gift chair. And Norm has served Stanford in so many ways, more than I can state. So I'm actually going to let Norm kind of talk you through his own journey in his volunteer service to Stanford. And he'll introduce our Plan Gift team who's here. So Norm's going to serve as the moderator of our call, and I'm going to turn it over to Norm now. Thank you, Norm.
Thank you, Erin. It's a pleasure to be talking with all of you today. It's been part of my value system that those of us who've had so many opportunities in life, we have a responsibility to give back when we can. And so I've done a number of things. I've actually started doing phone calls as a volunteer raiser shortly after I got back to the Bay Area after business school in the 1970s. I spent the last 30 years professionally as a financial advisor and a financial planner. I've made many charitable giving discussions as one of my focuses. So it's been an honor to be able to use some of that experience to help Stanford in my own small way. I'm joined today by 3 real experts in the plan giving area. And one of the things that I appreciate in my professional role working in the Bay Area has been able to, the interactions that I've had over the years with Stanford people. Stanford just consistently has real experts. And we have 3 today: Jonrie Dávila, Blake Grossman, and Jeff Underwood from Stanford's Plan Giving office. They do plan giving, obviously, but they do a lot more as well. And that said, I want to emphasize something that all of you need to be aware of, and that is that you, as volunteers, don't need to be an expert in the area of plan giving. It's what Blake and Jonrie and Jeff are all about, and others in their group. Stanford has a unique group of attorneys, as I said, and you can call on them to come up with their conversations with your classmates. Their primary role is to be helpful in these kinds of situations. So don't hesitate to call on them with your questions or when you want to bring in some more expertise. So our experts today are Jonrie Dávila, graduated in 1991, earning her JD from Hastings College of Law in 1984. She practiced law at firms in Nevada and California, including Holtzman, Weiss, and Shepard in Palo Alto. She then served as a fundraiser at Stanford and at other universities, and returned to Stanford and has been working in the Office of Plan Giving since 2001. Welcome, Jonrie.
Thank you very much, Norm.
Blake Grossman received his BA from Indiana University in Bloomington in 2003 and his JD from Golden Gate University School of Law in 2007. Blake practiced as a trust and estates attorney at Springs and Associates in San Francisco before joining Stanford in 2013. Welcome, Blake.
Thank you very much, Norm.
And Jeff Underwood joined the Office of Plan Giving this year after working at CIA Caspic as a plan giving officer, as a gift planning consultant and relationship manager for over 10 years. Jeff earned his bachelor's degree at the University of Missouri, Kansas City in 1984 and his MBA from Northeastern University in 1995. So, and welcome, Jeff.
Thanks, Norm. Good to be here.
With all of that, let's get started. So my first question is to Blake. Blake, I know you and Jonrie and Jeff are going to discuss specific types of planned gifts on this call, but before we get into the gifting specifics, I thought it might be helpful to get your take on the impact that the new tax act has had on charitable giving as a whole.
Yeah, Norm, thanks for asking that. So the new Tax Cuts and Jobs Act has some immediate recognizable changes that definitely impact Stanford and our donors. So for gifts of cash, the maximum charitable income tax deduction amount was actually increased from 50% to 60% of one's adjusted gross income. And what that means is that if you were to give a $100,000 gift of cash to Stanford in 2018, and your adjusted gross income in 2018 was $100,000, that you could now take an immediate charitable income tax deduction, $60,000 for 2018, compared to only being able to take a deduction of $50,000 in 2017. For gifts of appreciated assets, which we'll talk about a little bit more later, the maximum charitable income tax deduction amount that you can take from your adjusted gross income is still at 30%. And I also wanted to point out that at a later point in this conversation, we'll talk about how you can address the carry forward of any unused charitable income tax deduction, meaning that you're not necessarily, if you can't use it, you lose it. You're going to have some carry forward that Jeff's going to actually address later. The act also created what we saw as a limitation on the ability of an individual to deduct state income tax and property taxes, about $10,000. And there's also been an increase in the standard deduction to $12,000 for an individual and $24,000 for a couple. As a result of these kind of specific limitations, and obviously, I guess, an increase related to the standard deduction, we've seen a trend in what we know as donors are engaging in what they do is bunching their gifts in either 1 year or every few years they're planning on doing that. And by giving it through a donor advised fund, they'll give a larger gift now and then basically be able to take the standard deduction in certain years and then itemize the deduction in the years that they are making that larger gift to the donor advised fund. One thing I wanted to point out to all of you is if a classmate notes that their giving pattern is kind of something like this, that you can encourage them to consider either front loading or back loading their pledge over a 5-year period. And if they front load their giving by making a gift to a donor advised fund, they can continue giving annually by requesting a distribution from their DAF to keep with their annual loyalty giving. And I also wanted to point out that no matter how the payments are made, the full amount of the commitment will be counted towards your reunion. And something also to consider that pledges up to 5 years between your union are counted towards your reunion year. And another trend that our office also has been seeing is an uptick in donors giving what's called a qualified charitable distribution gift to Stanford. And that applies for donors that are 70 years plus. In that situation, from their IRA. So what it ends up being is that a person will make a distribution up to $100,000 from their IRA directly to a charity, and it can qualify for their required minimum distribution. And the person doesn't receive a charitable income tax deduction in the year of that gift, but they no longer have to recognize the income that they otherwise would have to recognize on receiving the required minimum distribution. The one key component we always have to make sure that we are talking to people about is that the gift technically has to come directly from the IRA plan administrator to Stanford. It can't go through the individual. So if you have questions that your classmates raise relating to gifts from their retirement plans, please feel free to contact the class giving officer that you're working with, and we would be happy to have plan giving get looped in and really help you with your classmates with any types of gifts like that. Another thing to kind of consider is that the new act basically doubled the estate and gift tax exemption to $11,180,000 per person. And the impact of this is that certain donors who may have previously planned to leave a substantial amount of their estate to a charity to avoid estate tax may now decide to give more to non-charitable recipients during their lifetime or at death, leaving less to charity. However, we are noticing that some people will increase gifts to their children to take advantage of this increasing exemption. And one way for a philanthropically minded person to support their children is to create a charitable remainder trust with their children as the beneficiaries. We're going to actually discuss this idea more in greater detail when we talk a little bit more about the vehicles and the different types of plan giving vehicles that you can think about. Another change that we noticed that will impact our supporters of Stanford athletics is that the law that allowed gifts for priority seating at athletic events to be deducted to the extent of 80% of the gift's value was repealed, which means that for any gifts given in connection with priority seating, you can no longer take a charitable deduction. That said, we still count gifts for seating priority as part of your reunion recognition at the total amount of that commitment. And something I want kind of people to consider when they're thinking about the new tax act is it has only been in place for less than a year and a half. So the charitable impact and how people's giving is going to change is really something that's kind of unknown. We're not really hearing much about it until now when people are starting to file. So it's going to be something that's changing and we can always be aware of it. And I thought that kind of talking about this tax act, Norm, I know that you were saying that you spent, your career as a financial planner. And I wanted to ask if you might have been having some conversations with your clients that may have been more charitably inclined since the tax act has come into play.
Oh yeah, absolutely. As you suggested, Blake, the change in the estate tax exemption has pushed concern for estate taxes beyond the concern of most of our clients. A couple is $22+ million, and most of our clients are below that level somewhat in their net worths. So estate taxes as a tax issue is no longer a concern. It doesn't mean that people don't need to do estate planning, but the taxes themselves are less a concern for most of our clients. And it means that they have to rethink their strategies both for charitable gifting and for other wealth transfer plans. The even bigger change we've seen is in regards to the deductibility of state income taxes and the increase in the standard deduction, which meant that some of our clients are not getting the full benefit of the charitable deductions that they do on a regular basis. So as you suggested, we've been aggressively advising them to bunch their charitable contributions into 1 year and do effectively 1 year for the next 2, 3, 4, 5 years in a row so that they can get a larger portion of that amount deductible. And the way to do that, most typically, is to make use of a donor advised fund where they can make a large gift in 1 year and then spread it out to the charities over several years. On a personal note, my wife, Linda, and I got married a bit later in life in Sedona, Arizona. And since we didn't need any wedding presents at the time in our lives, one of the fun things that she and I did was we created a donor advised fund, which we named the Sedona Fund, and asked people to make a gift to our Sedona Fund rather than to give us salt and pepper shakers or the other typical wedding gifts. So it made it deductible for our friends, and it gave us a small stash to enable us to make gifts to our favorite causes like Stanford. And we continue to use the Sedona Fund for much of our gifting even now. So with that, my next question to Jeff. Jeff, as a financial planner, I find myself discussing the benefits of giving appreciated securities and other assets to charities. Can you address some of the issues related to gifts of appreciated assets?
Sure, I'd be happy to, Norm. The one big benefit with giving appreciated property outright to charity is the ability to avoid the potential capital gains tax that a donor might incur if they otherwise just sold that asset themselves. So it really is a tax-wise or tax-efficient way of giving by leveraging that ability to avoid the tax and put more of the value of that asset to work towards your gift purpose. So it's a very effective strategy. I think a lot of people who typically write out a check for their gifts could just pause and consider if they have an appreciated asset that they might use instead of just writing that cash check for their gift. Now, for gifts of appreciated property, Blake mentioned there is a deduction limitation in the year of the gift. For appreciated property, that's 30% of your adjusted gross income. But there is the ability to carry forward any unused portion of that deduction for the next 5 tax years. And that's the same with gifts of cash as well that are subject to the 60% AGI limitation. So that's one thing to consider. Also, for gifts of appreciated property, where it's something other than stock that's publicly traded, where the value is very easy to determine. Other types of property, you have to obtain what's called a qualified appraisal to substantiate the value that you're going to claim for the charitable deduction. So those are all things to keep in mind with gifts of appreciated property.
So I know, Jeff, in working with my clients, that people write checks out of their checkbook on a regular basis for most of their gifting, and they forget to think about the tax saving opportunities of gifting appreciated securities, where charities benefit equally, but it makes it a less costly way to make the gift for my clients and for individuals in general. So other than publicly traded stock, what other types of gifts of appreciated assets should our clients be thinking about, Jeff?
Sure. Well, there's several other types. I think the most common type we encounter a lot here in our office are gifts of real estate as appreciated property gifts. Obviously, that's an asset that lots of people hold, and they've held it for a while, so it's the potential for it to be highly appreciated is very common, where you might have low cost basis compared to what the current value is. So it can be, real estate can be a great gift for those types of appreciated property gifts, either made outright or even put into a life income gift that we'll be addressing a little bit later on in this call. So real estate is a big one. Other types of appreciated property can be things like restricted publicly traded stock or even private stock. If there's a gift of a business interest that might be closely held stock or private stock. Now, those can certainly get more complicated in terms of the mechanics of how those gifts work. But if that's an asset that might make sense for you or those that you're talking with, we can certainly talk more with you about those specific situations. And I would encourage you to just contact your plan giving or your class giving officer to put you in contact with someone in our office to discuss that. Other appreciated assets to consider could be tangible property or collectibles, such as art collections. We've seen those come up from time to time, and those can be appreciated assets. So again, the ability to avoid the gain on the disposition of those assets can make some sense. So we're here to support those types of gifts because they do get a little bit more complicated. And we're happy to talk with any of those that you might come across.
Thanks, Jeff. I know I just sold my business last year, and I was hoping originally to contribute some of the shares to charity prior to the sale, both to support charity like Stanford and to give me more tax deductibility. Unfortunately, we were an S corporation. It turned out that form of incorporation doesn't allow for that kind of gifting that we had in mind. Any comments on that, Jeff?
No, that rings true, Norm. Even though technically, I guess a charity can hold S corp stocks, there's some negative tax aspects when the charity disposes of that stock that really doesn't make that an effective gift asset. So that makes total sense what you're saying there.
Mm-hmm. But again, I would encourage all of you on the call. If you know people are getting along in years and they're business owners, it oftentimes can be an attractive planning opportunity to be thinking about gifting part of the shares of their closely held company to a charity like Stanford prior to the sale, prior to it being finalized. And it kind of if in your conversation that topic happens to come up, it's oftentimes worth mentioning. My next question is to Jonrie. I wonder if you can talk about, other than making an outright gift to support Stanford today, are there specific types of plan giving vehicles that might be appropriate for our classmates to consider?
Yes, there absolutely are. There are a couple of types that are quite common that will provide income to the donors or to someone else that they might want to benefit with it, with the income from the arrangement. And that typically the income is for the rest of the lives of the donors or the other people that they name as beneficiaries. And then when they pass away, what's left in the arrangement goes to support the charitable purpose that the donors have selected. here at Stanford. And so we often refer to these kinds of gifts as life income gifts. It's a sort of a catch-all term. The two most commonly used planned gift vehicles of this type at Stanford are the charitable gift annuity and the charitable remainder unitrust. Now, a charitable gift annuity, which we often will refer to as a CGA, you know how we at Stanford love to abbreviate things. Well, we're not the only ones that do it in this case, but it is a little less tongue twisting to just call it a CGA. With a CGA, the payout that will be paid to either the donors, if they've named themselves as the people to receive income from it, or the others that they've named, it's based on the age of the person who's going to receive that income. And so this type of gift vehicle is most appropriate in most cases for someone who's over the age of 70, because frankly, the rates don't get very good until after you're over about 70. The payout to the recipient is a fixed annual amount for the remainder of that person's life, or if two people are named, it's for typically for the remainder of their life together and also that of the survivor. And that payout, one of the best things about it is that the promise to pay that amount to these people is Stanford's promise. And so it's backed up by all of Stanford's assets if Stanford should use up all of the assets that were given to it by the donors. The donor can use cash or publicly traded stock to create the charitable gift annuity. And most of the time, it seems that donors who are interested in this type of vehicle are looking to diversify their portfolio, so to speak, so that this is an asset that provides them with a very dependable fixed payout. They know they can rely on it for the future, and they don't have to manage it. They don't have to do anything, and it's a counterbalance to other investments that they may have variable income coming from them. There are also a few different types of charitable gift annuities that can be appealing to someone who's younger, typically still for someone who's in the range of 50 to 70. They are arrangements where the donor postpones the first income payment for a number of years so that they can get a higher rate that they will be paid on that arrangement. So if any of your classmates express an interest in this type of vehicle, please encourage them, again, as we've said before, to contact the class giving officer, who will then rope into the conversation one of us in the planned giving office so we can discuss it in more detail. The second big type of planned gift that provides lifetime income is the charitable remainder unitrust. Again, we often refer to it as a CRUT, C-R-U-T, and it's a very common type of planned gift that Stanford offers to its donors. In this kind of a situation, the donor creates a trust with a gift of cash or an appreciated asset, and then the trust itself sells the asset, and the proceeds of that sale are then invested and pay out income to the recipients, the beneficiaries of the trust, which may be the donors, but may not be. They may choose, as we mentioned earlier, could possibly be something that people would set up for their children, or even someone else. It doesn't have to be a person who's related to you. I actually worked with one donor who set this up as a type of a retirement vehicle for a longtime family employee. In any case, the income is paid to the named beneficiaries for the rest of their lives. And one of the nice things is that for charitable remainder trusts for which Stanford is serving as a trustee, the payout rate can vary. You can choose the rate anywhere between 5 and 7%, with the annual payout being that percentage multiplied by the value of the assets that are held by the trust each year. So it recalculates the income to be paid on each January 1st. Now, unlike with a charitable gift annuity, which can only be with Stanford established with cash or publicly traded stock, A charitable remainder unit trust can be established with real estate or other types of appreciated assets. And we've really seen a trend of this kind of giving with real estate. There's actually a type of CRUT that works beautifully with real estate. Many people who are, as they get older, contemplating moving into a retirement facility and facing that situation that Jeff mentioned of having to decide what to do with their homes that have appreciated so much. And in many cases, or perhaps most cases, people don't like the thought of paying capital gains tax on that enormous appreciation. So they can make a gift of either the entire residence or a fractional interest in it to a charitable remainder trust. And then the property is sold, and the pro rata share of the sale proceeds goes to the CRUT, and then whatever piece, if the owner has kept a piece, the pro rata share goes to them individually. And sometimes that arrangement can help provide the donor with both the money that they need to buy into the retirement community, and then the income stream that they are getting from the charitable remainder trust for the rest of their lives can often cover their ongoing expenses of living in the community. So in many cases, it's a very nice vehicle to use if that is a situation that someone's facing. One of the things that's important, though, to note is when you are using real estate as the asset to create a charitable remainder unit trust, you cannot live in that home once you've deeded any interest in it to the charitable remainder trust. Very important fact. So you have to be moved out and not using the property for anything else after you've transferred an interest in the house to the charitable remainder trust. Another troubling and difficult situation is if the house has a mortgage on it. It can be done, but it's very messy and very sort of complicated. And so we generally advise that the mortgage, if there is one, be cleared off before you create the charitable remainder trust. Another benefit of choosing Stanford to serve as the trustee is that, in contrast to many trust companies and banks and other entities or individuals who serve as trustees for charitable remainder trusts, is Stanford charges what we believe is a quite low fee. We do not charge anything simply for serving as a trustee, but we do charge for the cost of administration and investment expenses of the trust. However, we cap that at 30 basis points of the value of the assets of the trust. And for any who are not accustomed to what that terminology means, is that would be 0.3%. And so in comparison to some of our commercial competitors, it's quite low. And it may seem surprising that way. I've had a few bank trustees challenge me on that. And the reason for it is relatively simple. We have a vested interest in the trust because Stanford is going to receive money ultimately from the trust, whereas a bank trustee or any commercial trustee doesn't. They're not going to be receiving anything from it. So we have an interest in keeping those costs low. So I should also mention that, as my colleagues already know, I've often said that if I had the assets to create a charitable remainder unit trust for myself and my husband, I would do it in a heartbeat, because I just think it's a really wonderful vehicle for a combination of charitable giving and also providing yourself some income for the rest of your life. So when you read in the newspaper that I've won the lottery, I will. And I mentioned once before also that a charitable remainder trust or a charitable gift annuity, both of those vehicles can be created for someone besides the donor. And so very often that is what people want to do. They want to benefit themselves, but they can absolutely name someone else that they want to provide some income to. but not enable them to have access to the principal.
Thank you, Jonrie. In my experience as a financial advisor, both of these, the charitable gift annuity and the charitable remainder trust, solve kind of the primary problem that people come to us for, and that is, I'm afraid I might run out of money at some point later in my life, and I'm concerned about that. And particularly the charitable gift annuity solves that problem, and typically the charitable remainder trust can as well. So they're both great tools. Jonrie, both you and Jeff have mentioned, somebody can use real estate to make a gift to Stanford. Are there other types of ways that somebody can use real estate to make a gift to Stanford?
Yes, there's one very useful one, and that is, it's called, or we call it, a retained life estate. And a retained life estate is when donors during their lifetime make a gift of their residence that the arrangement allows them to continue living in that property until they pass away. But they get, because they have done it during their lifetime, they get a charitable deduction on their income taxes, not a deduction through their estate, if their estate even needs one. The donors, as I said, live in their home for the rest of their joint lifetimes and that of the survivor. They enter into an agreement with Stanford that obliges them to basically treat the home as their own for the rest of their lives. So they promise to keep up the maintenance and keep up insurance and all that sort of thing because they are continuing to live in it. They do have to continue to pay the property taxes. Folks in California would want to know that, especially. But the nice thing about it is that it avoids probate, because the instant that the survivor of typically a couple passes away, the Stanford already owns the property and so has the right to take possession of it. So it's not a part of your estate. And Stanford will typically sell the property and use the proceeds of that sale as the donors have told us they want us to use it. So it can be a really lovely arrangement for someone who doesn't want to move out of their residence, but still wants to make a gift of that residence to the university.
Thank you, Jonrie. So Blake, I'm a believer in giving back. Over the years, I've been able to make varying amounts of generally small annual gifts, but I've also structured my will so that 10% of my estate goes to charity at my death, of which Stanford is going to be an important part. A client long ago suggested to me that her 3 kids, instead of them getting 33 1/3% each, if they just got 30%, they wouldn't hardly notice, but that it could make a big difference to charity. And so I've adopted that approach in my life to ensure that my kids are going to get plenty, but Stanford and other charities are also going to benefit. From a planning perspective, it helps ensure that I'll have those funds available to me during my lifetime, but at the end, I can make a difference with what's left after my death. I've generally given my gifts to Stanford's general fund rather than to something specific, since I figure Stanford has a better handle on its needs than I do. So Blake, beyond reserving amounts in your will or trust, are there other ways one might think to include a bequest to Stanford in their estate plans?
Yeah, Norm, there definitely is. There are actually a variety of ways that someone might include a gift, like that we consider a bequest intention in their estate plan. As you kind of hit on, the most common that people of all ages are doing is through their will or their trust. And one thing that I wanted to kind of raise is that depending on the purpose that someone would like to support, I think that any one of the volunteers should recommend to their classmates that they can contact their class giving officer and to request that someone from the plan giving office provide them with sample language. Because if you're not in a situation like you are, where you want to just support generally to Stanford, our office can provide sample language to an alum to share with their estate planning attorney. If they, in a situation, have a desire to apportion that gift, maybe between undergraduate scholarships and cancer research to the School of Medicine. So our office can easily help with any type of designation language that might be beneficial. Another way to make a bequest outside of in your will or your trust is through a beneficiary designation form in association to a life insurance policy, a retirement plan, pay on death or transfer on death accounts, or even the ultimate designation form relating to a donor advised fund that someone may have created. And our office actually is happy to work with anyone to provide kind of what we call a designation letter to specify the ultimate purpose of this gift to Stanford, because we've found that a lot of the beneficiary designation forms have very limited space in the documents that don't really allow for you to state anything else other than just the name of the charity. It doesn't really allow for you to expound upon what is your exact interest in how you would like those gifts to be used. So we can work with anyone to help with creating that beneficiary designation letter. One big advantage I wanted to bring up of naming a beneficiary charity as a beneficiary of a retirement plan is that the entire amount of your retirement plan would be transferred to the charity because the charity is tax exempt. If you designate your retirement plan to an individual, such as your children or a close friend or a family member, those individuals actually will have to pay income tax on the amount that they receive from their retirement plan. So something that we've noticed when we're working with financial planners or talking with financial planners or even estate planning attorneys for our donors is that they are going to be leaving gifts to their family and friends in their will or their trust because those assets are not going to be subject to income tax. And then they may be now designating a portion of their retirement plan to a charity such as Stanford.
Thank you. I know that when I let Stanford know that I'd already included a gift to support Stanford in my estate plans, I was invited to become a member of Stanford's founding grant society. Jonrie, can you explain a little more to us about the founding grant society?
I'd be happy to. So as many of you may know, Stanford University was created by Jane and Leland Stanford through a document that was called the Founding Grant. So that when the Office of Plan Giving was looking for a name for the society to recognize and thank people who have included Stanford in their estate plans, much in the same way as Jane and Leland Stanford did, we decided that it was appropriate to name it the Founding Grant Society. There are no fees or obligations of being a member of the Founding Grant Society. Members are simply thanked as soon as they've let us know about their plans, and then invited to an annual event. It's usually a luncheon with faculty speakers and most often at least one performance by students. Often an arts performance, and singing seems to work well. The Founding Grant Society also will offer an annual desk calendar featuring photos or drawings of the Stanford campus that people are welcome to say that yes, they would like to have, but also if they don't want to have it, they don't certainly have to. We aren't going to force it on anyone. And I did also want to add that since I'm a Stanford grad, I chose to designate a part of my retirement plan to Stanford. And when I revealed that to the Office of Plan Giving, I was made a member of the Founding Grant Society. So I ask you all and all of the folks that you're talking with to please join me. And if any of your classmates indicate that they've already done this in their plans, please let your class giving officer know so that they can loop us in and we can make them members of the Founding Grant Society in just almost no time at all. It's our pleasure to ask or to thank them for what they've done. And we are particularly eager to have the opportunity to do that because it's a very sad situation when we receive a request that we did not know about before and that we have not had an opportunity to say thank you for.
Thank you, Jonrie. And thank you, Norm. Those are the questions I think we have for today. Norm, did you have any follow-up questions for our three gift officers here?
I do not. I think this has been very thorough. So thank you to Blake, Jeff, and Jonrie. I really appreciate it. And thank you for the opportunity, Erin.
Yes, thank you so much, Norm. We really appreciate your time today. And I don't have any questions here from the audience right now, but as I mentioned earlier, we'd be happy to follow up on anything that's striking your interest today, or you just like some extra tools for your toolkit as you go out and talk to the folks that you've been assigned to talk to for your own class campaign this year. And I just want to again say thank you so much, and we appreciate your time on the call today. And please let us know if there's anything that we can do to help make those calls more successful. Thank you, Blake and Jonrie and Jeff, for your time today, and we're happy that you all joined us.